Outgoing Revenue Secretary Tarun Bajaj has made simplifying capital gains tax almost a war cry. We can sympathize with his call. Let's just take a look at the bunch of rates we now have. First, definition of what is long-term differs from asset to asset. It's over 1 year for equities, over 2 years for REITs, and over 3 years for debt. Now, the tax is 15% plus surcharge and cess, which means 17.47% for equities. That is short term. Equities long-term capital gains tax is 10%, but add surcharge and cess, it becomes 11.684% or thereabouts. For debt, first, a mutual fund is defined as a debt fund if it holds less than 65% in equities. Okay? Here, the short term is your income tax slab. And for most investors, it would be 30%. Now, the long-term tax. The long-term tax, remember, in equities, it is 10. But for debt, it is 20% plus surcharge and cess. It is 23.296%. But in debt, you have indexation benefit. That is, whatever gain you make will be reduced to the extent of inflation. But no indexation or no lower long-term tax if you buy the debt outside mutual funds. Okay? And it's not just 17.47%. I'm going back to equities. It's not just 17.47% for short term and 11.64% for equities for long term. This is only for people whose total income is less than 50 lakhs. The rates change if you earn more than 50 lakh up to 1 crore. And it can even go higher in certain categories for 1 to 2 crore, for 2 to 5 crore, and for over 5 crore. And then there are different rules for capital loss set-off, as opposed to, of course, capital gains. So that's a welter of rules. Can this be simplified? Clearly, it needs to be. And what should the way forward be? I have with me guests who will be able to help us. We asked Dinesh Kanabar, the CEO of Dhruva Advisors, Sudhir Kapadia, National Tax Leader, Ernst & EY, Nilesh Shah, Managing Director, Kotak Mahindra Asset Management Company, and Mr. D.P. Singh, Deputy Managing Director and Chief Business Officer at SBI Mutual Fund. Gentlemen, thank you very much for joining me. Nilesh, first up, can you tell us if there are any low-hanging fruits over here, anything that we may expect as early as the current budget?
So, I'm not really expert on taxation like Dinesh Bhai or Sudhir Bhai, though I am a chartered accountant like them. But from a market point of view, I would like budget to plug the tax loopholes. Today, a zero coupon listed debenture converts interest income, which is normally taxable at income tax slab, as high as 43% in a case like me, to long-term capital gain and gets taxed at about 10% plus surcharge. Now, there is a cottage industry of people converting interest income to capital gain and reducing taxation by 33%. It's an easy loophole to plug. I hope budget takes care of that. The second loophole to plug is ULIP versus mutual fund. In mutual fund, when you move from debt to equity or vice versa, you end up paying short-term or long-term capital gains tax. In ULIP, that is not taxed. You can do as many transfers as you want between debt and equity and still not pay capital gains tax. Now, clearly, both ULIP and mutual funds serve the same purpose. There is a need to ensure that there is similar tax treatment. So these are the loopholes which needs to be plugged over and above the issues related to tenure between debt, equity, real estate, issues related to tax rates from normal slab rates to 10-20%, and issues related to structuring that all needs to sort out.
Okay. Got that. Plugging loopholes. I think you mean that they have this market-based debentures which are structured based on the Nifty's gain or loss, right? I've heard about that cottage industry. Mr. Singh, do you think that the tenure of long-term and short-term for equity and debt could be brought closer? I've heard from policymakers that it may not be good to make it identical because equity is inherently more risk. But do you think, a long-term LTCG for equities could be made 2 years or debt brought down?
Yeah, definitely. If Lata, if we think at when it was brought from 0 to 10%, it was almost 13 years. It was 0%, and it was equities were made 0 to 10%. Now debt was also 1%, 1 year, and it was made 1 year to 3 year. So I think there is a case. There is a case. There could be identical. Somewhere in between, there is a case for making it 20. I mean, up to 2 years if there are real issues. I think this will sort out a lot of the cases. What when we are talking about, there are so many rates, so many tenures. I think there is definitely a case of bringing them closer and making more uniform than ever before.
It's just that if you make equity long-term into 2 years, then perhaps the government may be making a little less money. I don't know if that'll, they'll make more money because there will be more short-term. So perhaps that's something that can tempt the government. Mr. Kanabar, have I outlined all the slabs or are there more? In the table you sent me, there was a different rate with STT, with indexation, without STT, with indexation. So it's more complex than I presented, right?
Well, it is, Lata, and it's veritable nightmare for advisors because you need a chart before you can really advise a client. So let me make two comments. First, for example, you mentioned about equity and you mentioned about no indexation, but then you have a cost rebase of 31st January 2018. So when there was no capital gains tax on equity, capital gains was brought in, and therefore cost was reset to 2018. So that is one other thing. Then if you happen to be a non-resident, then you get currency sort of coverage in a sense that you compute capital gains in the currency of investment. And then, of course, you do not get indexation, etc. So it is veritable sort of a nightmare looking at each type of taxpayer, each type of instrument, the rate and the period difference. And you ask Nilesh about the low-hanging fruit, and Nilesh rightly articulated about this cottage industry and use a very right term for converting sort of what is otherwise interest into a capital gain. But I have another point to make, that probably the government needs to relook at the maximum marginal rate itself. I do not think 42% is a rate which one should look at. We brought it down to 35. That is 30 plus surcharge. And then we put sort of a super rich surcharge. And a surcharge cannot become a permanent fixture, Lata. It has to be for a specific purpose, for a specific period of time, with this surcharge continuing. And when you start pushing rates at 42%, that's where you tempt people to relook and sort of restructure. I can tell you that I've seen people who are very comfortable saying 35% looks a very right thing, but when they go to 42, then they start restructuring to say, does this make sense at all? So probably there is a need to relook at that, and therefore the need to relook at surcharge. I would agree with the point which was made earlier, that you cannot have this multiple tenures. And I know that the stock market will not like this, but 1 year to be considered as long-term probably doesn't make sense. I was hearing the revenue secretary earlier, and he mentioned that last year there was a demand that he heard from the housing industry, where the housing industry wanted long-term to be 1 year, and he looked at somebody in the eyes and said, that can 1 year ever be a long-term from a housing perspective? It cannot be. But 1 year cannot be a long-term from any perspective whatsoever.
Okay, yeah, I mean, this will be music to the ears of the government as well, if short-term can be extended to 2 years for equities. Mr. Kapadia, what is your sense? Do you think that there can be some initial announcements in the budget? Because overhauling the whole thing may take a long time. So should we be prepared for something in the budget?
So Lata, first of all, compliments to you and Nilesh, being very modest, saying you are not tax experts. But I think, if I may say, you articulated the issues perhaps much better than I can speak for myself. I won't speak for Dinesh. But coming to what can be done. So if I may take a step back, it was alluded to. I think there has been a significant reform already. in the sense we have amended two significant tax treaties, Mauritius and Singapore, to bring horizontal equity between domestic and foreign investors on capital gains taxation, especially on equities. Then we have also brought in, as rightly pointed out by Mr. Singh, long-term capital gains tax after a long period. And grandfathering some complexity was required because grandfathering was fair. So fairness was also taken care of. So I think I must commend the government for bringing in these two very significant reforms, which previous governments were not willing to bite the bullet. And we have seen, the figures, and Nilesh will be a better person to say this, but I don't think it has had any deleterious impact on the markets. Now, the part about the reforms, I think the one easy and short, low-hanging fruit, Lata, the point you made, is clearly alignment of the holding period. Because there, I agree with all the comments made. There doesn't seem to be much merit, particularly in real estate holding period for long-term being 2 years, debt being 3 years, listed being 1 year, unlisted 2 years, so on and so forth. I think specifically on debt in a country such as ours, where a lot of people still depend and look up to debt for their investments, particularly with inflation and higher rates of interest, there is merit in certainly shortening the holding period for debt. And the very important point you made, Lata, I don't have the figures, and it's an interesting analysis to be made for another debate. But actually, when you increase the velocity of transactions by reducing the holding period, you might actually get a higher tax intake, right? Because today I'm tempted to hold back till the holding period is achieved. So holding period rationalization, I think, is a low-hanging fruit.
Got it.
The last point on rates, we must be mindful that you have a wide rainbow of policies across the world.
Yes.
As we know, in the US, the rate is still high on long term. The short point to be made here is, I think, the way we are in India, we want to still encourage more formalization in the economy. It is good to have these slightly attractive rates for long-term capital gains. As far as short-term is concerned, Lata, I don't think there is any complexity. We can talk about the broader rates, which Dinesh was alluding to. But short-term capital gains has to be taxed as normal income is all over the world. And therefore, the normal rates apply. So I don't think this is a complexity feature as far as capital gains taxes.
Yes, Mr. Kapadia, I have to go into a break, but there are lots more questions on why should you get a tax benefit only if you buy debt through mutual fund and not if you buy outside, as well whether the tenures of short and long term for debt and equity need to be brought closer, equated. All those questions after the break to my guests. Welcome back. Outgoing Revenue Secretary Tarun Bajaj has clearly indicated the government's intent to rationalize capital gains taxes, simplify the regime. I have been speaking with Dinesh Kanabar, Sudhir Kapadia, Nilesh Shah and DP Singh about how they might go through the process, just starting a public debate. Nilesh, one of the puzzling things is that you get a debt long-term advantage only if you go through a mutual fund. Now, Reserve Bank has this retail direct. Why would I ever, although I have an account, why do I buy bonds over there? Because I will not get the tax benefit. Is that a rationalization that will come?
Logically, I have no argument against that. However, considering the nation stage at which debt mutual fund is and the number of people who are investing otherwise because of their greed into chit funds and collective investment scheme, I will recommend that at least for some time, let this taxation continue. Now, compared to ULIP, debt mutual funds are at a huge disadvantage. And compared to bank deposits, debt mutual funds do have some advantage. But Government of India gives an implicit guarantee for bank deposits. Today, there's no fear in the mind of depositors that there could be risk to their deposit. It is thanks to the government's implicit guarantee. Debt mutual fund does not have that kind of guarantee. And hence, maybe it is needed that they should get some concessional benefits so that we can popularize debt among retail investors.
Okay. Take your point. There will also be a lot of corporates which will be using this, and the government may not want to give them tax advantages. if they allowed indexation and
Corporates will be, just one point, very few corporates will be invested for 3 years in India. They are mainly at the liquid end.
Yes.
And the net taxation and the capital gain taxation there is hardly any difference
For them.
So mutual funds tax benefits will primarily go to retail investors and marginally to some corporate investors.
Fair enough. Mr. Singh, I mean, let me ask you again the blanket question I asked the others. Is there anything that comes to your mind, that perhaps will be first off the shelf in the budget itself? Because after all, it's only 2 months to the budget.
No, yeah, one thing which comes in my mind is, see, today we are at the cusp of a big growth. And here the mutual funds must be given the mutual fund investor must be given some special incentive to route their investment through mutual funds. Because, see, a lot of research is a regulated entity, research goes behind it. And as Nilesh Bhai said, people should not end up putting in their investments in the stocks or in the debt instruments which are otherwise looking very attractive. So just to encourage the right kind of growth, it will help not only the industry, but will help the investors also to route their investment through a very well regulated this thing. I think even if there is a change in the tenure or there's a change something, there must be some special incentive if the investments are routed through the mutual fund route.
Okay, no, that you are an excellent spokesperson for your industry, Mr. Singh, but I don't think the taxman only thinks like that. If it was only to protect the small industry, why is it that 50% of your investments are coming from corporates? Technically, the taxman will say, I will not give it for corporates at all. They already have other exemptions. Anyway.
No, let it be. Let it be only for the retail investors, Lata. That's fine. That's the fine.
Okay, okay. There may be another lobby against it, but I can see that that's something the government may want to look at to encourage the mutual fund culture. Mr. Dinesh Kanabar, I don't know the extent to which there are slabs, income tax. This gets, enmeshed also into personal income tax laws. So are you expecting anything in the budget itself, or will it be cosmetic in the budget and a larger code later?
It's actually a little bit of a tenuous question, Lata, if I may say so. I had really hoped, and I think all chambers of commerce have pitched very hard to say that the surcharge which has been increased for, so to say, the super rich needs to be relooked at it. And I would have sincerely hoped that would have happened last year, or again, it could happen this year. My hopes are a little bit dampened after I saw what happened in UK when there was an attempt to reduce the tax on the super rich, and I don't know how will the government look at it. But clearly, that surcharge has no specific basis. It has just become a way of enhancing the rate of tax. As I mentioned earlier, that a surcharge has to be for a specific purpose, for a specific period of time. It cannot be an endless exercise. And therefore, there is a need to relook. And that, of course, has its shadow on computation of capital gains tax. Just one other point Sudhir made earlier about short-term capital gains and that it should be taxed at a normal rate everywhere in the world. But again, in India, we do have a situation where if it is a short-term capital gain on a listed security, we have a separate rate of tax. You have been asking this question, Lata, that will we see some low-hanging fruit and can something be happen in a budget and can something be long-term? But this is not too complex an amendment to make even in one budget. Sure, one has to take into account the capital market formation, the need to get monies into equity, the government disinvestment program and all of that. But really, clearing some of this is not too difficult a job at all. All that you need to do is to really put the holding period, the rates of tax, and then surcharge, of course, is not specific only to capital gains, but to all slabs of income.
Okay, fair enough. Mr. Kapadia, will the government also have to worry about the FPI angle when they rationalize any of the taxes?
I think absolutely, Rata. I was just going to respond to Dinesh's last comment. What I meant was that the normal rates which are applicable for
income tax,
normal individuals will apply for short term. But the fact that there is a 15% rate, there is a reason. And you rightly said, Lata, that the reason is, of course, the attempt has been over the years to keep increasing the flow of FPI and then, of course, FDI. And if I may say, and we all know the geopolitical situation, the uncertainty in the following year, I personally think Government of India will not want to bite the bullet so soon when we still need to attract a lot of foreign capital, a lot of investments, look at just the needs in the economy, etc. And mind you, as I mentioned earlier, one significant reform of having a 0% capital gains tax has already been addressed. So instead of just tinkering with rates, I think we should keep encouraging more investments, both domestic as well as foreign in the market. There are no exemptions being given under the current scheme. Aligning the holding period is a fair expectation. And I think we have a long way to go. And I'll just make one more point without getting into the politics of it. When we are talking about this debate between NPS, the defined contribution versus defined benefit, I would say as we mature and as we see that there is reasonable, sustainable return of investment money to be made in the markets, automatically this politically, induced demands of going back to a very archaic system, which has been, of course,
Mr. Kapadia,
successive governments have wanted to reform.
Mr. Kapadia, I don't think we have enough time even for short-term and long-term discussion. That takes it to another level.
No, I'm saying
but I agree with you. Yeah, I agree with you.
It's important that we don't take the clock back and therefore not make the rate so unattractive.
No. Absolutely. I take your point over there. It's just that, that makes it another discussion. Nilesh Shah, just from this foreign point of view, last question actually for the discussion. Do you think if we are anyway much more competitive than others in terms of taxes, that's what you said, is there a scope that the rates may be increased, short-term or long-term in equities? That is the most important question for equity investors.
So I hope and pray that doesn't happen, because we levied STT in lieu of short-term and capital gain. Now capital gain and STT both are continuing. And now if we increase short-term rates to normal income tax slab, then please abolish STT. You can't have cake and eat it too.
Yes, sir. I agree with you that the government really has a lot to watch for. But I guess in the days to come, there will be a lot that they will reach out to you for in terms of advice. Thank you very much for setting the ball rolling on where do we go from here on capital gains tax. Mr. Singh, Nilesh, Mr. Kapadia and Mr. Kanabar. Thank you very much for joining.
Get the grip of good health even